The way you move your body is smooth. And everything's so unexpected. The way you right and left it. So you can keep on shaking it. Never really knew that she could dance like this. She make up her head when it's Spanish. Como se llama? Shakira, Shakira. Oh, baby, when you talk.
Shakira, Shakira, Shakira. Everybody hear me okay? Somebody give me a voice check. Am I too loud, too low? Where am I? I had to make a last minute change on my microphone. I had a little technical challenge here. Sounds okay? All right, great. So a little Shakira to start us off. That's because way back in time when I first started coaching, it was pretty typical for Forex educators and trainers to have a handle, if you will. And so Shakira's song Hips Don't Lie was out there, and so I thought it would be kind of fun to take the Pips Don't Lie handle. And so that's where that all got started. So I'm glad you were able to carve some time out here tonight. This session will be recorded, but your presence is requested to be here live because that's when you get to ask questions. And questions are always what make live seminars very, very good and thorough, in my opinion. So, got a large group here tonight, which I really love to see. And tonight's webinar is called Why You Might Consider Using Pitchforks in Your Forex Trading. So, I want to point out that this is a question in a webinar. Okay, to cause you to reflect on your trading. It's not really a training class on Pitchforks, although we'll get into some things. I'm going to go so fast through it that if you're not familiar with Pitchforks, it's nothing you're going to be able to grasp, and that's not a statement about your intelligence, but you know, it is a skill set. It does require a little practice, but the practice is worth it, as I will show you as we move on. First things first, you know, anytime I do anything with the Forex, we got to go through all the proper stuff. So I have to give you this typical CFTC warning, and that the currency market carries high risk and might not be suitable for everybody. Past performance is not indicative of future results. High degree of leverage can work against you as well as it works for you. You should consider your investment objectives, level of experience, and risk appetite. So I'll let that up here for a few seconds. When you watch the video, you obviously have a chance to pause the stream and read all of it if you wish. We will be talking about trades. Some of the conversation will involve pips as such. It's kind of important for some of this crowd who isn't that familiar with me to, I think it adds to know a little bit about the person that you're dealing with. So I'm going to go ahead and just give a quick 2-minute background on me. Let me see. I have 2 dogs. I love the mountains. I have 4 children in 2 sets, an older set of daughters and a younger son and a younger daughter. I coached basketball for about 5 years. That's my son playing there. Love to be involved in the family. I like to spend my time in the mountains in the spare time. Kind of a weekend warrior once, twice a month in the spring and late summer, early fall. Up in the Sierra Nevadas, I love to go gold prospecting. I have 3 or 4 claims up in the Sierras, right in the middle of the old mother lode, if you will. I've been trading for quite a while and coaching for just a little less than quite a while. I've had an organization, a community of traders called Pip Club for many years now, and we are all about mastery. We're all about, you know, trying to make the most money in the most practical way. That means low risk, high yield. And so while the currency market does involve, you know, some risk, it doesn't involve too much risk when you use some of the methodologies that we have. Somebody is saying they can't hear. The volume is still okay on the voice. Somebody give me a yes, okay. Okay. So thank you. So, Pip Club has been around a long time, as you can see, and we just are a community of traders that have some common goals. I'm not a rookie to the market. You can see some stuff here going back to '84. Yeah, ancient dinosaur here for some of you millennials. I brought the first technical analysis software product to the IBM PC. I worked closely with Lotus Development Corporation. We had the first live real-time quotes in the airwaves way before Wi-Fi was around. I got a PC Magazine Editor's Choice in their financial editorial, competing against 48 other products. Won a first place for my financial product that I had listed there. So been around a little bit. In terms of this is essentially a IML invited list. iMarkets Live is indeed a Forex network marketing company. And I was in the very first Forex marketing company many years ago. That's how I got my coaching start. And I had the #1 team in a company called FX Trainer. And what happened there was a little bit like happening here is, if you bring a customer on and the customer wants to learn how to trade, you want to help that person learn how to trade. It's not about recruiting people into an MLM. It's about sharing an opportunity for them with just a computer and an internet connection to go off and make as much money as they want and have freedom. And so way back when, I started supporting people who showed an interest in trading and joining that network marketing company as traders. Some of them turned into business builders because they liked sharing the opportunity themselves. So I'm not exactly untested in the coaching area, supporting thousands of traders at a time. Over the years, I've been very heavily invested in developing, in research, in history, because I want to have the most profitable trading there is. And that doesn't always mean you have to be a 99% winner. It doesn't always, you don't always have to know exactly what the central banks of Japan's interest rate announcements have to do with trading that day. But from a technical standpoint, there are things going on in the charts that 99% of the traders don't understand. And so I have something I call the new paradigm of trading. And right now, if you're an existing trader, unless you're already on one of my teams, you're pretty much trading in the old paradigm of trading. And there are certain characteristics about the old paradigm. One, typically, the psychological side is very hard to grasp because your trading essentially works against it. And I don't have time tonight to go into all the stuff that I would normally like to go in with traders. I could spend a week on Pitchforks and the mental game. But the new paradigm is about giving you lower risk and higher yield into trading. And we're going to look at that a little tonight. But anyway, several years back, I invented something called harmonic wave convergence. And really what it is it's a way of having multiple time frame wave exhaustion synchronization and being able to see that on one chart in one indicator field. It's very precise. Now, there's only one other thing in trading today that gives you a new paradigm capability that lets you have the lowest risk and the highest yield in your trading, and that's Pitchforks, which is what we're here for tonight. In that end, because IML customer/traders have access to certain products along with their membership in IML for those that are in IML, one of the things I've done is supported traders, whether they're affiliated with me or not, in a Facebook group called iMarkets Live Scans, Forex, Fibos, and Profits Traders Group. And what we do in that group is share insights about scans, Forex, Fibos, and profits. And so one of my specialties the last few years has been to take harmonic scans and work with Forex in order to bring more validity to the scan and for the scan to provide some assistance to the fork. So it's kind of a unique combination, but it's been great. Now, along this end, I have been talking with Jason for a long time. Many of you know Jason Brown. And we've exchanged ideas. I think he said something to my team about we've worked at arm's length over the past year. And over the last 4 to 5 months, Jason and I have talked more and more about me bringing some of the technology I'm using in this group with IML traders, with the iMarkets Live harmonic scanner, and some of my Pitchfork skill set that I've acquired over the years in advanced Fibonacci, and bringing that to IML. And so we've come to a conclusion that it would be a good thing to do. And so many of you may have seen the announcement Jason made yesterday about my becoming an educator. This is a mock-up. This is not the true IML TV schedule, but I'm just making the announcement now. Within the next couple of weeks, you'll see me on here, and we'll have 2 or 3 times a week where we will be doing scans, forks, fibos, and profits work per the IML TV schedule. So it's very exciting for those of you who are IML members and real serious about your trading. So a little bit about objectives tonight and some thinking. You're not, the reality is you have to have a dream and a purpose and the why. And I want to step back 1 second and talk about, iMarkets Live as a network marketing company. There's so many cool things that IML is doing right now. It's not even funny. The vision is very grand. And what you've seen happen in the last, 2 to 6 months with the evolution and continued build out of the IML Academy and IML TV, it's just phenomenal. It's absolutely phenomenal. And to realize now we have a Spanish channel, there's a German channel coming online, there's a French channel coming online, there's a Portuguese channel coming online, and all of those just continue to explode. I mean, right now with the Forex chicks and Stevenson Linder on there, and then me, and there's a couple more coming on. I mean, you're going to be over 60, 65 hours a week, and then the Spanish channels are on top of that. It's just unbelievable. The amount of training. Now, I'm not doing a sales pitch here for you non-IML people, but to the people already in IML, the education, the access that you have to true, good, quality education with the educators at IML is just, there's nothing that's close to it. So one of the nice things about having a network marketing structure is that the people that do kind of share the opportunity as business builders are very driven. They're doing their self-development work. They're growing. You have to grow in order to be successful in that level of the business. And here's an interesting thing I can tell you in coaching over 13 years now is that you have to do the same self-growth as a trader. You have to go through growth. And the one thing that drives that growth is your dream. If your dream isn't big enough, the obstacles are going to get too big for you. Oh, I'm too tired to be on the charts tonight. Oh, I haven't had any good trades in the last couple of days. Oh, I'd rather go out drinking beer with the boys. Oh, I'd rather do the bowling league this weekend. And you're not working any on yourself. And so as a Forex trader, you're going to have to grow, and it's going to have to be a dream. You're going to have a purpose. That dream has to be something enough to make you passionate. And in my dealing with thousands of traders over the years, I can tell you one thing. I can tell who doesn't have a dream because their obstacles are real big. There's an inverse relationship between the size of the dream and the size of the obstacle, and that is the bigger the dream, the smaller the obstacle. The smaller the dream, the bigger the obstacles. And so you will note just in your everyday life, and of course, the business builders know this as they try and work and help their customers move forward in their trading education. The people that have, all the complaints all the time and are whining, the negative Nancy's and all that stuff, guess what? They have very small dreams. Because the other people who have big dreams, they're plowing right through what seems to be an obstacle for somebody else. And so, hey, the reality is you have to have a dream. You're not going to become a Forex trader without it. It just doesn't work. So that why has to be important. Now, tonight, I want to talk to you about why you trade what you trade. If you're brand new to trading, you've been at it a week or you're thinking about it, you're not going to have an answer to this question yet. And when I say, why do you trade what you trade, I'm talking about, do you just say, well, somebody says this is how you trade. The reality is there are so many ways you can trade. It should serve your lifestyle. It should serve your financial objectives. And for some people, that's going to be set and forget trades at 1700 Eastern with sometimes 200 pip stop losses. For some people, that's going to be all the way down to scalping because they could literally sit on the charts 8 hours a day, 10 hours a day. For some people, it's going to be a hybrid of everything in between. 4-hour trades, 30-minute trades, 15-minute trades, 1-minute trades. There's so many things that are possible. And that's the beauty of the Forex, is it can accommodate your lifestyle. So you don't want to settle in too fast because as a beginner, you don't understand all these capabilities. You want to explore, which means you don't want to have unrealistic expectations. That's the quickest thing that's going to kill you as a trader, is having unrealistic expectations. So get with somebody who knows what they're doing with their trading and talk to them about expectations. This is not the holy grail, get rich overnight. You're not going to buy it on Friday and be trading it on Monday. It just doesn't work that way. Okay. So we want to determine why you trade what you trade, because tonight, as we look at Pitchforks, we're going to answer some of that question. I'm going to have you ponder what you're doing with your trading. And I'm going to tease you with something that you might want to consider, which is why the title of the webinar was why you might consider using Pitchforks in your Forex trading. Again, I can't teach you everything about Pitchforks tonight. I'm going to show you a little bit about their woo-woo magic, because there's a lot of woo-woo in the charts. Okay. What is a stop loss? Now, of the traders that are out there, I guarantee you about 95% of them don't know the reality of what a stop loss is. Everybody's going to give you the Forex 101 answer. Well, a stop loss is there in the event the trade goes against you. It's there to stop your loss. Yes, that's correct. There's a bigger thing about the stop loss, and most traders don't understand it. They're not aware of it. They really don't know what the deal is with the stop loss. So I'm going to teach you that tonight. Again, I'm going to show it to you. You may not comprehend how to do it and understand it all, but I'm going to get you to drop your jaw on the ground a couple of times tonight. Do the math. This is so important. You have to do the math in your trading. Trading is nothing more than stacking probabilities. And the more probabilities at a higher percentage of potential, the more probabilities you could stack together, the more successful you're going to be over time. You have to understand the risk. You have to understand your lifestyle choices. There's not just one way to trade, and you're going to see that tonight. The mental game dictated by risk, stop loss, money management, and results. As I said, old paradigm trading, this is my opinion as a trader, but I've been at it quite a while. And I've looked at hundreds of systems over, multiple time frames. The results you get are in part two things. They're the financial results you get, and they dictate what happens in your head. If you're trading in an environment that has inconsistency, it's going to wreak havoc on your mental game. If you're trading in a system that has big swings, you're going to have results that are going to give you future big swings. If you're over-risking because you don't understand risk, if you're over-risking because you think you're going to come in here and win the big ticket lottery, if you're over-risking because you had unrealistic expectations when you came in, oh, my job's going to be over at the end of September, I got to start making, can I start trading live by October 1st, Jason? Let me see who's here. Hey, Boo. How many times have people asked you that, right? How soon you could start trading live? And if they don't do the right research with their knowledgeable traders on their team, they're going to set the wrong expectations. That'll kill your game. All right, let's cut right into it. I want to talk about a couple of things. We're going to get into risk and stop losses a little, because that's going to set us up for understanding why Pitchforks can be so significant. Everybody okay so far? Did I lose anybody? Everybody okay with the approach we're taking tonight and what we're going to achieve? All right, let's go. Let's go. Let's go. So here's a typical MT4 harmonic scan as provided by IML. And I want to point out a couple of things on this chart. First of all, we've got price moving up. And so when there's about 9% of this last move from C to D, wherever C is down here, coming up to the D, whenever there's about 9% left, that's when this scan is going to be made available. And it has a lot of information on it. It comes out with entry zones based on what's called the PRZ, which is the potential reversal zone. That's a terminology. In this case, it's a bearish pattern. The D is going to be a termination point, suggesting we should have a pretty large swing reversal. And there's some information through the IML programming that makes this a very informative chart. Notice here we have a green line, which is entry zone line start. So this is the potential. Now the way these lines get formed is we have a series of moves that form these Gartley kind of patterns, butterflies, crabs, etc. And the relationships of the price as it moves into these various moves and its Fibonacci relationships determine what kind of pattern this is and the reversal. And a lot of this technology, deep back in time in the late 90s, was developed by a gentleman called Scott Carney, named Scott Carney. And Scott did a lot of work taking these patterns, and some of these patterns, basic patterns, go back to 1922 with Gartley's. And what Scott was able to discover is there's some of it's Fibonacci, some of it's derivatives of Fibonacci. We're just going to call it all Fibonacci, although some of it isn't true Fibonacci. It's just ratios that appear time and time again. What he determined was there's certain ratio mixtures of these retracements and extended retracements and whatnot that appear in a sequence of swings that then, when combined together, give you a very, in this case, as I said, a bearish kind of move, have a high degree of accuracy on this move down. Now, there's been two major studies, one from Carney's group itself and another one, another independent group aside from Carney. And essentially what they came up with for the various patterns, sharks, Gartleys, etc., crabs, there was a 89 to 93% success rate with these. And what they considered success was at least a 15% move from the D. So at least a 15% move. The kind of move that 89 to 93% of the time says I could get in this trade and I shouldn't lose anything. Now, how much of this goes beyond 15% is another story. The studies they did, and they've looked at, literally, I think when I summed up and compiled the two studies, somebody might remember, about 126,000 patterns they reviewed that were scanned, predicted, and had this kind of success rate. So they can be very successful. The trouble is they can be a little tricky, and now you've got to worry about things like scale. So in this particular example, we're looking at a 1 hour pattern for the Aussie dollar. And this is the D, the termination point. And on its way up, like I said, when we get about 9% or 91% from C to D, this is going to paint. And it's okay, Antonio, don't worry. And what happens then is there's a zone, a PRZ, where some of those Fibonacci numbers are going to paint a line up here, and some of those Fibonacci sequences together paint a line here. And so this yellow block, as I've colored it, becomes the PRZ, the potential reversal zone. On your MT4 charts, this is identified by when there's two like that, an entry start and a secondary entry end. So there's two lines. Somewhere in there is going to be the reversal per this pattern. You'll notice that the distance between E and ES, entry start and entry end, is 47 pips. The distance from the first entry line to the recommended stop loss is 80 pips, and the distance from the second recommended entry to the stop loss was 33 pips. So somewhere in there will be the size of your stop loss, somewhere between 33 and 80. Just depends on where this thing actually turns around. Okay. So what you want to see here, and what I want to impress upon you, is the size of these stop losses. Now, this is a 1-hour chart. Those are not atypical stop losses for a 1-hour chart. Not at all. Now, here's what happens with patterns. Now, again, I know we came here for Pitchforks. We're not doing harmonic pattern training here. By the way, if you want to get a foundational knowledge of how to trade harmonic patterns, Jed Rich has a very nice IML TV schedule where he goes over that and does a great job with it. So, plug for Jed and IML TV for the harmonic scans sessions that occur live each week. So here's the reality with a scan entry. There's really 4 types of scan entries. Okay, we have one where the scan paints and the entry is a single line entry, and the reversal actually takes place right at that line. Those are the ones that just woohoo, make you smile, right? A second one is where the D and the reversal, where the reverse is at D, actually occurs slightly before the entry line. Sometimes people are waiting for that trade to get up there and they miss it because it occurs before it. Obviously, sometimes it goes past it. The reversal D and the reversal end or start past the entry line. And then the fourth is where maybe 2 lines are painting because of the nature of the pattern and the Fibonacci sequences that create this PRZ, and the reversal occurs somewhere inside that PRZ. So those are essentially the 4 types. Now, we could probably create subtypes, but in a general sense, that's going to be the 4 types on a harmonic scan. So the question is, how do I know where that is? This is why we have to have a stop loss that is somewhere, up here. Because we just don't know which one of these is really the entry, and we have to have some wiggle room on either side of it. This pattern is not drawn to scale, folks, so please understand that. I'm just getting it on the screen for you. And the eventual entry, okay, there's many ways you could do it. A lot of traders, advanced traders, are going to look for market structure. So when they see this D point and price starts to reverse from that D point, they might look for some market structure. In some simple ways, without getting too advanced, essentially they're looking for the start of an Elliott wave move, an impulsive Elliott wave move out of there. So they're looking for a 1-2 move, and then when they see that 2 move making out, some traders will enter there, and then some will wait until we actually clear the 1 wave before they would enter the trade. All right, so a little market structure. But again, traders that aren't that versed in market structure and Elliott wave and market geometry sometimes just have to take the entry if it's in there, apply the stop loss to their trade, and if the D rises up a little on them before it reverses, it's okay. It's within their margin of safety per the stop loss. For the most part, is everybody with me on that? Trying to test the level of knowledge that our traders have. Come on, I want to see it stream. This is interactive. I need you guys to interact because the hard thing about coaching over the internet and online is I don't get you see you, I can't see you nod your head yes or no. Okay. You can ask questions, but there's no messaging in between traders. All right. So there we have the general entry. So what I did for fun is a couple months back, I went to the IML web scanner and I pulled up 4-hour trades. All 4-hour harmonic scans that were showing as active at the time, I pulled up. And these are those 13 that I pulled up. It was 27th of February, so a little bit more than a couple of months back. So I pulled them all up. And then I did a little analysis on each one of these 13 of the 4-hour trades. So see, this is what I do, guys. I'm kind of a little bit a mixture of an entrepreneur, a little bit of MacGyver, a little bit of Lewis and Clark. I'm an explorer, a little bit of OCD mathematician, because I want to know what's going on. You know why? Because I'm the CEO of my $10 million trading company. That's why. Now, asterisk note, it's not a $10 million trading company. I'm acting as if I'm going to be there. So I don't treat this as a hobby. I hope I make that clear. This was 4-hour scans that I looked at. And what I can show you with this is what that data looks like here and how I put it into a spreadsheet. Very careful now, follow with me. Again, you don't have to grasp it, but just follow. So we have a stop loss, okay? And we have an entry point. And we have an entry point. So we have 2 entry points. As you can notice, this entry was a little bit above the D, let me say, rephrase it. The D was a little bit above this first entry line. So we used the actual entry price, which was 1082.86. We go back to the stop, which was 103.07. We had a 202 pip stop loss on this. This is a 4-hour trade. Again, not atypical, not unusual for a 4-hour trade that is where the CD span is pretty large. Okay, because this could be a big trade. So if we put 2% into the trade, not 5%, not 10%, but 2%, kind of a standard scenario for a trader that kind of knows what's going on. Not more than that. You can trade less, 1.5, 1, 0.5, it's okay. 2%, and I'll explain why I use 2% a little later on. So for this trade to move in our favor, and we're just going to talk about an all-out exit because you got to pick something to make math, to have something to analyze. As long as you do it the same way across the board, you're okay. So if this trade went 50 pips, we'd make 0.5%. If this trade goes 100 pips, we make 1%. If it goes 250 pips, we make 2.5%. Because we have 2% into the trade, based on the size of the stop loss. Which means if we entered this trade at the entry point where D was reversing, and it came down and then went back up and took us out at the stop loss, we would lose 2% of our account. Okay. So I then put that into a spreadsheet for those 13 trades that came up on the web scanner on February 27th. I noted whether it was a sell or a buy. I noted where our stop loss was, where our entry was, and calculated the size of the stop loss. So there's that very first one, and it came out to 202 pips. And we're going to put 2% into every trade. So you can see as we go across these 4-hour trades, these 4-hour harmonic scans, where it painted the entry information for us, you can see the various size stop losses: 62, 24, 94, 463, 201, 195. Interesting trade here. It's very tight, smaller move, but hey, 24 pips in that stop loss. 140, 239. Come out, the average stop loss across all 13 4-hour trades was 148.2. That's not speculation. That's not guesstimating. That is math as printed on the chart. So 150 pips in the stop loss across those trades. Now again, we have the same thing. We can guesstimate through calculation what our return on account would be based on the number of pips we gained in that trade. And I just want to look at the 100. That's why I highlighted this field. So on this particular trade, notice we put 2% into our 202 pip stop loss. If we made 100 pips, we made 1%. Over here, because the stop loss was smaller, and I'm putting my 2% risk into that smaller stop loss, I can actually have more lots into the trade. This is how you do fixed percentage risk analysis. And so the return I'm going to get varies based on what? What is this return based on? Somebody put it in the question box. What is this return based on? We're all making 100 pips, and we all have 2% in each one of these trades. What's the return on account based on? Exactly, the size of the stop loss. So now, you kind of beginners, and some that might be at this for a while who haven't looked at it from this perspective, I said early on, a lot of traders don't know what the stop loss is. Yes, it's there to stop your loss. Your stop loss is your profit regulator, pure and simple. The bigger the stop loss, the less dollars per pip you're going to make in any given trade. The smaller your stop loss, the more pips you're going to make in any given trade. You'll notice that in these cases, the guy with the 24 pip stop loss, which was an anomaly out of all 13, but the guy with the 24 pip stop loss who risked no more than 2% of his account in the trade, same risk every one of these other guys would have had in their trades in these various pairs. When he made 100 pips, he made 8.4% return. The guy that had the 202 pip stop loss, he made 1%. So you can see right away, there's a big difference. When I have a tight stop, my percentage return goes way up. Why is that? Because I can put more lots into the same trade. You put 2% into the stop loss, which means here I have 24 pips. I can put 2% of my account into it. So I can buy a whole lot more lots because I only have to cover 2% of my account into 24 lots. Over here, I can only buy a handful of lots because that same 2% of my account has to cover 202 pips. So here I have less lots. Here I have more lots. I don't want to spend too much time on this. There is a video, I can show you where it is, which goes through this in very strong detail. It'll help you understand this. But the bottom line is, you can't just arbitrarily say, well, I think I'll use a 24 pip stop loss instead of 202 because it makes me more money. It'll make me 8.4% return versus a 1% return. You can't do that. There's a reason these stop losses are there. There's a reason they average 148 on a 4-hour trade. All right. So now I want to introduce a concept to you that's kind of going to blow some of your minds. Some of you have seen some of my presentations before. You know I've touched on this. All my trading team knows this from being around me for a long time. But I'm going to tease you with something, and it's not a tease, it is a reality. And the question is, how would you like to make 10 times the profit you're making now? Same account size, same trades, but 10 times the profit. Is anybody up for that? So I have a question. Are these figures and tools available with IML membership? Well, each of the instructors at IML does something differently. It's going to be available because I'm going to teach it. So how's that? Since I'm coming on board as one of the educators, my channel is going to feature this kind of understanding. Smart trading, low risk, high yield. Okay. All right. So 10 times the profit. Now, here's how we're going to do that. We're going to use very tight stop losses. And the first thing I want to do before I show you how that's going to be done, I want to whet your appetite with the math. Now, you can say it's hypothetical because it's in a spreadsheet, and the CFTC would remind you that hypothetical results, past performance, blah, blah, blah. And they're correct with one exception. If something is assumed, let me say how I could say this. If something is assumed to generate 2, and you're going to do that 2 times, it is not hypothetical to say that would be 4. If you're going to assume that's possible, then multiplying it by 2 does give you 4. That is not a hypothetical number. Because what I'm going to do is say, well, this is how you trade in the old paradigm. You generate 2. In the new paradigm, guess what? We're going to generate the same 2. So you cannot question my 2. Because if that's what you're doing in the old paradigm, that's what we're going to do here too. We're taking that same trade as an example. The difference here is we may have a bigger multiplier. And so this math might come out much different. This does not become a hypothetical number. It's no more hypothetical than this is. If 2 is a given, 2 times it is 4. If I can show you how to amplify this multiplier so you get this instead of this, that's the name of the game. So that's what we're going to do. So first, let's look at the math, because you have to be, your appetite has to be whetted by the math. Why is that? Because I'm going to show you stuff tonight in the next 30 to 40 minutes. I'm going to show you some stuff that will generate that multiplier for you. But let's look at the math first, because that's important to understand. So what I did here was I took the same trades, the same 13 trades, and said, what if I could get in those trades with a 10 pip stop loss? Now, I don't want to tell you the reality of this because it's even better than that, but I'm just going to scare some people away. So let's just say a 10 pip stop loss. Same trades. When that same trade now goes 100 pips, because I have my 2% into a 10 pip stop loss, I'm making a 20% return. Remember the guy that was following the stop loss on the harmonic pattern printout? And he would use that 202 pip stop loss. And when it goes 100 pips, he makes 1%. So there's a 20 multiplier. 20% in one trade. What about when it goes 200 pips and he's making 2%? Guess what? 40%, because it's a 20x multiplier against this average. Against this average, 148 versus 10, right? So this is what should interest you. Now, if we go all the way with this and throw some account sizes on it, so we can matrix this essentially into the third, into a third dimension instead of just XY. Let's look at it at Z as well. So the difference there is on this trade with the 202 pip stop loss, if I had $2,500 in my trading account with that same 100 pip gain that was here in purple, I made 100 pips, that 1% return brings me $25. That same $2,500 account with the same 100 pip gain, over here I'm earning 20%. So I just made $500. Now I don't know about you, in one trade, which would you rather make on your $2,500 account? That's not over risking no more than 2%. Can anybody get excited by that? Not hypothetical. This is real. See, the part that's hypothetical would say, well, if it goes 100 pips. Well, I'm saying it goes 100 pips for you and for me. So it's the same 100 pip move. If we're going to say, yeah, I can see 202, 2% into it, 100 pips, I get a 1% return. This doesn't become hypothetical just because the number's big. It's based on the same 100 pip gain that you would have. Does that make sense? So take it a little deeper. Okay? Take the average, those 148.2 pips. So for 148.2 pips in the stop loss with a 100 pip gain, the average gain at 100 pips with the average stop loss was 1.3% versus your 20. For a $10,000 account, that means you made $135 and I made $2,000. Somewhere in there, and I'm not going to take this to the next level and compound 10 trades to show you the difference, because you would not believe it. But if you know anything about compounding and you duplicated this over 10 trades and then 20 trades and then 6 months of trades, you have to ask yourself, why am I sitting here? Why am I trading 150 pip stop losses? If I have a technology that lets me enter a trade with 10 pip stop loss, and I can put my 2% in that. And it probably carries a higher percentage of win than this does anyway. So it's a lower risk, higher yield opportunity. So some of you are like, what? And that's okay. You know, I said you don't have to understand it all. All you have to understand is some simple math. And the simple math is, which would you rather have, $2,000 on a trade or $135 on the same $10,000 account? For the same trade that goes 100 pips. For the same entry and the same not stop loss. Different stop losses. There's the key. That's why stop loss is not just about stopping the loss. The stop loss is your profit regulator in a trade. Again, you can't do it arbitrarily. There has to be some method to the madness. Let's look at this, how it kind of looks in more chart form. So what we have on the left is your typical scenario where I have a pattern and it comes down to a D. Now this could be anything, guys. You know, this might be your moving average cross, this might be your MACD cross, and what you know is the higher time frame you go, the bigger the stop loss gets, because you have to take care of scale and lag. So as you move from, you know, a 5-minute chart to a 1-hour chart to a 4-hour chart, that stop loss has to grow because there's more lag on those indicators as you move upstream. So it doesn't matter what your real method of trading here is. Maybe these two entry points represent a support and resistance field on a 4-hour chart or a daily chart. You know, you've identified some support and resistance in there, and price is heading down towards that region. Once again, market geometry, how am I, if it starts to go up there, am I in the trade? Well, maybe it's going to come down and go up again. Maybe it's going to come down and go up again. How do I know which one of these? It's really hard for a newer trader to get that science down. Okay. So we have these double entries. We have our stop loss setback. I only said 100 pips. I just showed you 13 4-hour trades. It was 148.2. So I'm being conservative here in the size of this stop loss. Well, here's the thing about the stop loss and gain. Listen to this real closely, because this is the magic in the numbers. If I use a 100 pip stop loss and I have 2% at risk in the trade in that 100 pip stop loss, what it means is for every 100 pips this trade generates, I make 2%. The same thing that happens if I back up 100 pips on my trade and it takes me out at minus 2% works on the gain side. So every 100 pips here, I'm making 2%. If I tighten up my stop loss, the same is true. If I have a way of getting in here really tight, high percentage opportunity, and I can get in here with a 10 pip stop loss and I put my 2% in the 10 pip stop loss, it also means for every 10 pips, I'm making 2%. 2%, 4%, 6%, 8%, 10%, 12, 14, 16. I go 100 pips, I have a 20% gain because every 10 pips now, I'm making 2%. That's why your stop loss is your profit regulator. And therefore, if I can achieve a tighter stop loss safely, I'm going to make much more money per trade as compared to my contemporary trading in the old paradigm with the big fat stop losses. Does everybody understand how that math works? 2% into a 100 pip stop loss versus 2% into a 10 pip stop loss. Over here, I'm only going to make 2% every 100 pips. Go another 100 pips up here to 200. I've now got a 4% return on account. It's not shabby. But if this actually went up the same 200 pips, not hypothetical, if this guy does it, then this guy can do it too. It's the same trade. Then he's at a 40% return. we're not going to worry about getting out, because the same thing over here is the same concern you're going to have over here, i.e. how much am I going to road, what marks the exit, etc. That's a whole nother conversation. And let me just tell you this, the technology that we have over here is going to give you less erosion over here than you have over here. So of that 200 pips, you're going to keep more of it over here than you are over here. But I don't have time tonight to get into all of that. I just want you to understand the math. When you create a stop loss and you put risk into the trade, you're putting risk into that number of pips. That determines it's called position sizing. It determines how many lots you can put into the trade. Here I could put in more lots. That's not more risk, it's more lots. All right, so where do we go from there? Let's take a real quick mini course on Pitchforks. All right, and before we do that, I want to talk about Fibonacci, because Fibonacci rules the universe. Fibonacci rules your charts. The charts are totally driven by Fibonacci. And I'm not talking about, well, I don't know what to tell you about the math other than the first thing you need to do is this. You have to understand position sizing. So you're not going to appreciate any of this unless you understand how you do position sizing. Position sizing requires certain variables. It requires how much money you have in your account. It requires the type of account you're trading. You know, is it a standard account with $10 lots, or a mini account with $1 lots, or a micro account with 10-cent lots? All right. It has to take into consideration the risk in the trade and then the size of your stop loss. So guess what? That, and that are all the same variables. The only thing that determines the number of lots you're going to put, see this is a formula, and it determines the number of lots you can put into the trade. It's called position sizing. I have a if you want a calculator to help understand that, you can go to FX, I hate writing this out because it's so much, FX Traders Calculator.com. And you can download what I consider to be the best position sizing calculator in the market. And I say that because I created it. Humble that I am. Okay. So you can get that free calculator there, fxtraderscalculator.com. There's your freebie gift for attending tonight. And that'll explain the position sizing. And you'll see the only variable that exists is the size of the stop loss. Size of the account's not going to change. If you're in a dollar account trading mini lots, it's not going to change. If you put 2% risk into the trade, it's not going to change. But there's a difference if I put 100 lots in here or I put 10 lots in here. If I put 10 lots in here, I'm going to get, when it comes down to calculating the number of lots, I'm going to get 10 times the number of lots I can put in the trade. And what you get paid on then is the number of lots times the number of pips. So if it moves 20 pips and I have 10 times the lots, I'm going to make 10 times the profit in the same distance. Here's the flip side of that, a little fun. All those guys that brag, hey, I made 800 pips last week. Woo! Right? And he's out there making 4-hour trades with, and I'll be generous again, 100 pip stop losses. And I go, oh, okay, that's nice. But guess what? I made the exact same amount of money with 80 pips of trading. So all of a sudden your 800 pips ain't so grand. Okay. Terry, you're not going to see it at this level because it's not taught at this level yet. Just keep watching that IML TV schedule, and I should be on there in the next week or two. So I will specialize in low volume, low risk, high yield trading. That's what I do. I achieve most of that with scans and forks. All right. So we talked about Fibonacci is pervasive anywhere. We're going to jump into Pitchforks real quick. All right. And granted, all of this, I can't present all of this because it's, I can't do but so much in the time frame. I'm already going over where I wanted to be at this point. So let me just move through this kind of quickly. Why median sets? Now, median sets, as you're going to find out in another few seconds, is another name for pitchforks. They contain channel price history, median sets evaluated against the current price action, thus in reality are real-time trading tools. They are not a lagging indicator. They're real-time, which is why we get to have tight stops when we use them. Median sets have precise turnaround zones. Thus, small stops can be used with them. Because of their consistency, they can be traded fairly objectively, thus complementing, not fighting, the trader's psychological growth. Go in and trade the same pitchfork bounce the same way every time. There's no thinking, there's no analysis. Is it bouncing off the pitchfork barrier or not? Median sets can be drawn and analyzed in the candlestick area. They don't take any indicator real estate up on your charts. They add a time factor as well, which isn't available in horizontal support and resistance. We'll talk about that later. They also give an indication of the direction of the channel and the trend. Because median lines are based 100% on Fibonacci relationships, which there are many, thus they help bring clarity to your support and resistance, but still within the context of the harmonics at play. That's very wordy. It just means the lines on a pitchfork are full of Fibonacci, and I'll show you why in a second. Median lines have a mathematical relationship probability of price reaching them. Now, these are observations that were made by the guy that invented pitchfork, Alan Andrews. They're relatively easy to learn. Now, some of you are going, oh my God, this is so overwhelming. Well, let me tell you, trading in the old paradigm is more overwhelming because you're going to have inconsistent results. And when you have inconsistent results and you don't know why the things that work, and why the things that don't work, it takes a long time to figure it out, which is why you'll see many traders 1, 2, 3, 4 years learning how to trade. Pitchforks you can get through very fast because they're easy to do. So when you start struggling with them, that struggle is in your head. That struggle is an obstacle because your dream is small. Just understand you're talking to somebody who's been trading since 2004, and I can tell you, if there was an easier way to trade that was more profitable, you'd be at a different webinar right now. And again, I tried to show you a few things at the beginning to bring me just a little bit of credibility if you don't know me. First technical analysis product on a PC. 48 other financial products. I got the Editor's Choice Award. Inc. 500 Fastest Growing Company Award. I would be doing a different trading methodology if there was one that was easier, safer, less risk, and more profitable. Guess what? There isn't. Median sets in your comfort zone. Right now, you need to eliminate your self-talk as justifying your non-use of median sets. I'm just not any good at drawing median sets. Well, you're not going to succeed in any other business either because you're giving yourself law of attraction to the negative. And you have to go through the self-growth and understand you can't have negative self-talk. Nobody comes out of mama's womb drawing pitchforks. It is not a native gift. It is learned. A little bit like liking yogurt. It's an acquired taste. It's more precise than divergence, Terry. But again, I am not out to discredit anybody or to say a trader needs to do one thing over another. The most successful trader does what? They win consistently. The profit in their mind that they make has to be worth the time they're expending. I've come across many successful traders in my early years when I was trading in the old paradigm as well with those big 100, 150, 200 pip stop losses who mastered trading. But if you don't have $50,000 in your account because that stop loss is so big and the return on investment is so small the time they were putting in, they really effectively could have made more money flipping burgers at McDonald's. So I know a lot of traders that burn out over the years because while they were successful at trading, they won more than they lost. And when they won, their risk to gain or their gain to risk was all mathematically great. The problem is the big fat stop loss meant there was only such amount of money they could make, which is why you see some IML traders out there putting 5% and 10% into the trades, because the gain that is earned is not sufficient in their head. So now they're gambling. I have a different way of approaching it, and that is to make more money in the trade in a safer way. Drawing pitchforks is a learned skill. Success in drawing analysis comes with time. I hear and I forget. I see and I remember. I do and I understand. The way you get good at pitchforks is by drawing them. Not going to go into the history, just know it comes from Newton's action-reaction. Babson made a lot of money off of it, $50 million way back when. Can't imagine what it would have been worth in today's amount. Alan Andrews comes along and invents the pitchfork. So I want to ask you a simple question. This is where we're kind of getting close to what we need to see. What is the source of support and resistance on Forex charts? What's the source of support and resistance? When you see Justin Adams or Christopher Derrick draw out support on a 4-hour chart, where does that come from? Well, if you've seen them draw it, you're going to say, well, repeated highs and lows. So what you need to understand is every swing high and every swing low is the result of a Fibonacci in some move in front of it. Every one of these swing highs and swing lows is a result of some Fibonacci in front of it. In other words, you're not going to be able to come up to a chart and say, hey, look at this, and I can't find you the Fibonacci in front of it that caused that reversal. Now, this is some of the woo-woo in the charts. So if I just took the top and bottom of a move and I applied some Fibonacci to it, I get some resultant stuff moving forward. And if I do that, oops. Okay. If I do that again and again and again, okay, give me a second here. I'm a little confused. Well, wow. Okay. Little technical issue here. Bear with me. Hang on. Let me see if that comes up now. Okay. So I'm having an issue here. Don't worry. We're going to get through this, and I'm just going to improvise real quick. So what ends up happening is with all of the swing highs and swing lows that come about, there's Fibonacci's in front of them. In other words, I could look at this chart move, if you will, and I can tell you that this top right here is the 38.2% of that retracement. And I can tell you this bottom right here is the 23.6% of that retracement. And I can tell you that this number down here is the 368% projection off that move. Every swing high and swing low, I can find the Fibonacci relationship in front of it. Now, what Alan Andrews did was he started trading medians. And a median is simply this. He had a price move. And it goes from this swing low to this swing high and down to a swing low again. Okay, and starts taking off. What Andrews would do is he would come in, I'll use yellow, and he would find the midpoint of this line. And then once he found that midpoint, he would go back to the previous swing low in this example and draw a line from that swing low through that midpoint. And that became known as the median line. And there were certain observations about that median line that he noticed. One of the biggest ones was from this swing low, for which he chose the midpoint, there was an 80% chance of price reaching the median. Now, in the trading world, that's pretty good. That's 80%, not 8. 80% chance from this swing low of price hitting the median. There were some other relationships that he determined as well. I'm not going to go over all of the observations. One of the things that he learned over time was that when price bounced off that median, because it could go through it, so what he discovered was price could come up to the median, it'll get there 80% of the time. Sometimes it went through it and went higher and then bounced. Sometimes it went through it and, like typical of a lot of support and resistance lines, it comes back and checks it before it takes off and goes up. And then sometimes it would hit that line and bounce right down. And what he discovered in a large number of trades in trend moves like this was an interesting thing, and that is he realized that if he took a line, if he cloned this median line and put it on top of this swing low, and he cloned that median line and he put it on the bottom of this swing low in the same parallel direction, all of a sudden he was getting these bounces. Now, those of you who are adequate trend line drawers, you know that if I connect two lines or 2 points, I can draw a trend line. The problem is there's no other low to connect a trend line to. This is the advantage of a median set. There's a mathematical midpoint here, and we can consider that a hit to the trend line, which allows us to draw that median. And then that allows us to drop a clone of that right down here. It's just now, Alan Andrews did all that by hand. We have tools to do that automatically for us. All we have to do is identify this swing high, this swing low, and we take our, in this case, swing high, swing low, we come back to a swing low, and we put it right on that tip right there, and our pitchfork is set. That's called a traditional pitchfork. When I use the swing high, the swing low, and back to the swing low, that's a traditional. Likewise, if I went to the swing high first, and then came down to the swing low, I would come back down to the previous swing low. So in that case, here's my midpoint. There would be, whoops, if I could draw a straight line, there would be my pitchfork. That would be a traditional going from a swing high to a swing low. This is swing high. Oh, I drew it in the same direction. Ah, how'd you guys let me do that? That has to go to a swing low. If it's pointing down, okay. If it's pointing down, we came up, we're going from a swing low to a swing high. Swing low to a swing high. We don't expect price to go up from a swing high. It wouldn't be a swing high. That's kind of silly. Why would price rise from a swing high? So Andrews comes in, finds his midpoint, right? This is typically higher. Okay, and then he draws his line from that swing high through the midpoint, and the parallels would go on, and now you have your downward facing meaning I had a swing high, price should go down from there. I have a swing low, price should go up. Same rule applies. From the swing high, 80% of the time, price is going to come down to this median line. So when he attached these copies of the median, his students, which was a median, some of his students called him a median set. Some of them said that looks like a pitchfork. So there it was born, Andrew's Pitchforks. The tool is now built into every charting package, and it's an automatic tool. All you have to do is identify a swing high and a swing low and come back here. Now those observations are pretty simple. Got to speed it up here. And that is this. We know from here I have the 80% chance of getting to the median. If it bounces off the median, it's going to come back down here and bounce off this. That is the high percentage move. If it crosses the median, it's going to go up and bounce off this upper wall. If it bounces off the upper wall, it's coming back down to the median. And it's going to do just the inverse of what it does here. It may bounce off of it. It may go through it and then come back and check it and then take off. So right here, as it came back down here, it might bounce back up to the top. It might come through it and go all the way to the other side. It might come through, check it, and then go. Simple combinations, Andrew's observations. Trend lines don't have those kinds of rules and observations. And traditional Forex give you trades before a trend line would give you a trade, one trade earlier. So they're very, very powerful. So you're going to have these reversals, you know, depending on the nature of the move. It's called a plunge or a gap. Whether it goes up, sometimes it will gap, and you know, because old stock technology, it's not so applicable to the Forex. So that's the essence of a pitchfork, okay, and the rules that apply to it. So instead of just drawing too much stuff, let's look at some pitchforks. And I think that's what we're going to do. So here's a bunch of pitchforks. Let me look at something more simple to start with. Here's a pitchfork with a scan. And here's what we're doing with this. This is called a best fit, because a best fit doesn't rely. We still have a swing low high and a swing low, but instead of this going back to another swing low, we're going to move the median up and down until we get some touches on the data. You'll notice if we move it up and down, we get this nice bounce off the median set. It does come back and breach it, but it does bounce right there. Notice by moving it up and down, not only do I get the nice hit off the median, I get a nice to the pip bounce here. Notice to the pip bounce. It just so happens that when I hold that angle where I get the touch here and I get the touch here, look at what happens when the scan finally paints. Where does this scan paint, by the way? Not until about here. Got to be 90% through the D move, 91% through the CD move before it paints. So the scanner paints, you know, somewhere in here in real time. I can have this pitchfork set as soon as I have this high and this high. Notice on this high, that does become a trade. We have rules on how to proceed and where to move our stops. We would have made profit on that, not tons, because does come back and reverse us, but we would have made good profit on it. That move comes all the way down and bounces off the bottom of my pitchfork. That's a trade entry. There's a secondary trade entry. Notice where that trade entry ends, at the median set. The median of the median set. That's just all profit. Price starts moving up, the scan finally paints, and lo and behold, it paints the D right on our median. That brings confirmation to this scan as price starts moving away from the median set that D is fixed. It's not going to go up any. The D is not going to come down any. That is the actual reversal. Woo-woo! A swing high and a swing low is merely when there are reversals in the move on the time period. And a period swing high and swing low are such that subsequent to that, you don't see anything bigger. So the period swing high here to swing low, like here, after that point, once that channel has been painted, you don't see anything essentially that goes outside it. Well, right here it breaches it just a little. So that's my swing high and swing low that covers the subsequent move until I have activity that leaves that channel. And it's a skill set you'll see over time. Notice the size of the moves here. We have a breakout of a trend channel. We have a breakout of it. That's now a swing low. So that's a great time to draw a pitchfork. Again, I'm not here to teach you pitchforks, guys. I'm here to just show you the precision they have so you can decide whether it's something you want to pursue. So when I move this up and down, I get a touch here, and I'm looking for an outside touch, and I got it. So right there, I can have my pitchfork set. I get confirmation, big move down, another hit right there. Price comes down all the way down. Where does it stop? At the bottom of my pitchfork. Another test at the bottom of my pitchfork. It moves up, another test of the median. This is a good pitchfork. It's going to bring me some money at some point. In this particular case, the scan paints, finally, my D is already identified. And I don't have to worry about it drifting up or drifting down. I could take this entry with a 10 pip stop loss. And while my contemporaries using this scan might be in here, look at where their stop is. $67 pips. I have a 10 pip stop loss. Guess what? Regardless of how far this goes, I'm making 7 times the profit. Woo woo. The web scanner is an OEM version of TradingView charts. TradingView charts up here, as you'll see in a few minutes, has a pitchfork tool. We'll look at a live chart maybe if we get through this. Let me look at a few more pitchfork examples. Continue to whet your appetite. Okay, this is one where we're actually going to use components of the scan itself. How do I know to do that? It's an upswing. So I'm looking for a swing low, swing high, swing high, swing low that's going to point up. Very often I'll use the XA to create a downward pointing fork. On a bullish move like this, I'm going to use the CD to be my swing high, my swing low. Now technically, I should come back to another swing low for this. Swing high to a swing low, swing low. I'm going to swing highs only because I noticed one particular thing. That when I put this median, as I move it up and down, when I put it on here, I got a hit here. And I got a hit here. And that's pretty exciting. So I get multiple hits on my pitchfork, on the median itself. That puts a real high value on this entry right here. That again is a 10 pip entry. Don't worry about it if you're not following. All I want you to see is we're getting in here with tight entries, and I'm showing you how we can with proven forks. Now this is a cool thing. I got some traders that really like doing this. You know, I'm not going to name all the names, but Tim Phillips does this a lot. Stephen Ma does this a lot. Tim Packets does this a lot. Tim Packets does this a lot. These are called fork fibos. Something we created a long time ago. It ends up being the same thing as an extended retrace. So we have a swing high to a swing low. This is a best fit because we're not bringing the pitchfork back to any other previous swing low. We're moving this up and down until we get some hits. We've got a couple of good hits. We have a beautiful hit here and a beautiful hit right here. And keep swinging. Still, those are fine. And then we get another confirmation hit right here, bounce off here. That says the angle that I have set with this is pretty good. I should be able to count on that. I got 1, 2, 3 good hits. We call these Fibonacci's. Don't worry about it. I got 1, 2, 3 good hits. Median, outer boundary, outer boundary. Where does it go from here? There's your trade entry, folks. Now, I want you to understand something about fork Fibos. Fork Fibos say if I put a Fibonacci on this and do an extended retracement. Now, an extended retracement means normally if I put a fib on this, I'm going back, what, 38, 50, 61.8. Here's the 100% line. So that represents 100% retracement. It's called an extended retracement because this retracement continues to move on up. And what I want you to see here is on these extended retracement moves. Look here at the 127% Fibo, purple, right here to the wick. Look at the 161.8 extended retracement to the pip, right there. Look at the 261.8 extended retracement. In other words, it came down here, and we're going up 261.8 to that line. Bingo. So a fork with these fork Fibos gives us multiple trades. This is called an energy point. When I have a diagonal of the pitchfork running through the horizontal of a Fibonacci, those are called energy points. They're very, very powerful, which is why you see this nice trade and that nice move subsequent to that. All right, so we can have swings, and you'll start to get a flavor for where you put pitchforks on the more you draw them. In this particular case, this pitchfork wasn't done to capture the trade. It does, but that wasn't the purpose of it. In essence, what this pitchfork was used for was, could I use the pitchfork for money management after the trade? Can I use the pitchfork to identify more trade opportunities? Because remember, these swing high, swing low that are associated with the scheme have all sorts of Fibonacci-ness inside of them. And so if I have something that kind of confers that, well, then we're pretty powerful. So we have a pitchfork. We swing this up and down until I get hits on the inside, until I get hits on the outside. And I'm swinging it up and down, and lo and behold, here's that 80% move to the median line. That's your first hint that that might be the right angle of the fork as I'm moving this thing up and down. This is not a traditional fork. I have no swing high or swing low to bring in here. We had a pretty decent trend drop down here. There's nothing to bring this pitchfork back to, so this has to be a best fit. So I move this up and down. I get a hit here as I move it up and down. I'm looking for a confirmation somewhere else. I have what we call a Fibonacci. This is just quads, another 25, 50, 75, 100 on each side. I get a quad hit right at the 50. I get a quad hit right at the 75 down here. Brings further confirmation to this hit here that I've got this fork set in the right place. Lo and behold, the D comes along. Maybe the D was already there when I drew this fork. Doesn't matter. The D would bring me good confirmation that the fork I have is set in the right place. Now, here's where this scan has brought me more money, even if I miss the scan trade. I've just aligned a pitchfork with it. There's all sorts of Fibonacci-ness, as I told you, in these swing high, swing low numbers. And then guess what happens when I have all this alignment? I have that median hit. I got a 50% quad here, 75% quad hit, another 50% quad hit at the D. Look at this trade right here. And where does it go? To the median. Folks, that's money in the bank. Now, I know this looks, well, gee, I hope you didn't come here expecting to do pitchforks, an hour after this session is over. It's not going to take you long to learn them. I'm giving you the motivation by showing you this trade here, I could enter with a 10 pip stop loss. I had such precision with everything else. I can enter this trade with the 10 pip stop loss. First of all, it's a trade that the scanner crew isn't getting. They got this trade here. Maybe if they, have some skills, they got that trade. Well, so did I. But more so, I'm getting the end of that trade. They don't see the end of that trade. What do they have as far as targets? They've got 38, they've got 61.8, and they've got 100 down here. See, they don't even make it to their last target. Price comes up, they might get stopped out here. There's a bunch of different ways you can use exit strategies for that. But they don't even get 100% of the move. I know to exit my sell at that point. It's shy of my last target. The pitchfork tells me it's going to bounce there. I get the bounce, I enter my buy. That's a CAR. We used to call that CAR in the old days. Cancel and reverse. Just cancel my sell, enter the buy. It used to be one button. FX Solutions Trading Station, one button. Cancel and reverse. You had a buy button, a sell button, and a CAR button. Cancel my sell, put it automatically into the buy. And that, where do I have for money management? Drives right up to the median where I expect it to go off a bottom bounce. All right, so I'm going to jump. Yeah, those are stuff I've done, over time. I want to jump to the team site, which is here. And I'm just going to scroll through. Now, when I say team site, this is a site I put together, 9 months ago, 10 months ago, for traders in IML. And you don't have to be in IML to access this site. It's a public site, does require approval, and I need to see that you're at least somewhat interested in trading. But it deals with scans, forks, fibos, and super profits. Okay, I'm the moderator, administrator for the site. It's really for technical traders, and so I've appealed to traders at IML who want to make super good profits and consistency, to come over here and learn some. There's no charge for this. It's just a free service. It's a community. And so you'll go through here and you'll see, you got to go through the normal stuff. You'll see various traders post trades that are in here that are Pitchfork, Scanner, or just Pitchfork related or just scan related. So those are announcing the webinar. Let me get down a little further. Okay. So here's one from Tim Phillips. So what he did here was he drew a best fit pitchfork. Okay. It went from swing low to swing high. Swing low to swing high. He moved the median up and down, and he got this trend going here. You can see 1, 2, 3, 4 hits on the top parallel as he moved this up and down. He set it there, and look what happened. To the pip bounce down here. He's got his pitchfork set at that point. He has an energy point here because he does a Fibo on this move. So these are that fork Fibo that I talked about, this extended retracement. So he looks at that and he comes down 138.2%. Look at how the intersection of that line and the intersection of the pitchfork bottom parallel meet to the pip. That's a 10 pip entry, 10 pip stop loss, and look at the profit. Okay. So these are traders that I help teach pitchforks. They put in the work. I just pointed them in the right direction and gave them some understanding of what to do, and they're doing it. Okay, here's another trader, Theo. He has a swing high to a swing low. He's doing a best fit. What does he use? He moves this up and down. And he matches it up with some bounces off the median, and then he gets a bounce down here. And he could drive this move, which is the CD move. This is a pullback on the CD move, and he gets to go all the way up to the D. So this was a move prior to the scan even painting. Again, the scan's not going to paint until it's 90% of the way to the D. So he has this pitchfork there, swinging the median, getting these hits along the way. Here's a beautiful hit. Here's a beautiful hit. He's getting hits on his median. And then, bingo, he has a trade, which goes all the way up to the D. Could go on and on and on. Let me see if there's any more kind of fun ones. This is another trader, Stephen Ma. And what he's showing here is, again, I showed this earlier, but I think his is even better. And again, Stephen's a student of mine. He's only been around trading since maybe November, so about 9 months. And only maybe in the last 3 to 4 months has taken up Pitchforks, owner of my tutorage. So he finds a swing low to a swing high. He's moving his pitchfork, and he lets the D be the bottom that he's aligning the pitchfork off of. So he's not using this pitchfork for the entry in the scan. He's using the Fibonacci-ness of the scan to help him set his pitchfork. When he swings this up and down to get the line here to stop at D, notice where price went all the way up to the C. So he's got an outside hit and an inside hit. His pitchfork angle is set. There's a trade. There's a trade. There's a trade. Very powerful. And see, the thing is, you got to get out of the habit of needing those big 500 pip trades. Why does everybody chase the pound yen? 500 pip trades. When you can make the same pips in 50 pips. Same number of same profit return in 50 pips. All right, I could go on and on here. No need to do that. Let me real quickly, Euro, Aussie. I'll bring up the pound yen since that's the big fave. So let's look at a 30-minute chart just for fun. I spend a lot of time on my 30-minute charts. Okay. So the first thing I would note when I look at my chart here is there was an up move here. It ends up here technically and starts moving down. We might call this a range. We might have a harmonic pattern in here, head and shoulders, whatever. I just want to stay with pitchforks. But I can tell now from this swing low to this swing high, we kind of got a downward pointing thing. So I want to explore that because it interests me. It's a pretty big swing. So I just come over to my pitchfork tool. Now I'm on TradingView. The same pitchfork tool is available on the web scanner. I drop it on my bottom and I stretch it up to the top. Oops. And I'm going to swing and play around a little and see what I got here. If I were to do a traditional swing low, swing high, I come back to the previous swing high, that would kind of be a traditional fork right there. And you'll notice I got some hits. I got a nice median here. It goes through the median, comes back and checks it. Remember I said that was one of Andrew's observations. If it goes through the median, it very often will come back and check it and then take off to the opposite side. That would have been a good trade right there if I kept this that way. Here's a quad. In other words, these are just divided into, well, these are just 50% lines, 50% channel lines on each side of the median. Get a nice bounce off that 50% line. That's a nice little trade. Don't need tons of pips, guys. When you're making 2% every 10 pips, you don't need huge pips to make good money. Are you a member, Antonio, of IML? Maybe there's another alignment on this fork I would look at. Let me erase my writing there. You can play around with these and see some interesting. Well, look at that. See, I like that right away. Why do I like that? Well, look at this. It's not a traditional fork because I'm not lining with a swing high or swing low here, but I move this up and down as I just did, and look at the touches I got. I have a median hit here, got a median hit here, got a couple more in here. More importantly, I have an outside hit here that I can now trade if I had the fork on here at this time. If I got the fork on here at this time, I would use this to bring confirmation to these previous hits on the median. This is now an outside confirmation. So again, I've got my angle set right. I like that. And where does this go? And even if that's all I got out of it, was that move right there, that bounce right there. Look at the pips that I made. 10%, 2% every 10 pips. See, it's about the setup. A good trader is going to spend 90% of their time in setups, only about 10% of their time trading. I want to go back and look at this up move though, because that also, now of course this is expired, but this is how you can go back, and this is the nice thing about Pitchforks is you can go to your time frame, go back. This is how you kind of essentially back test Pitchforks, if you will. You can draw them in the past. You don't have to use them to trade. You're not going to break your charts by drawing them, guys. So it's pretty easy to get in here and draw Pitchforks. So I like the looks of this just by, again, my eyes are tuned because I've been doing it for so long. You get those eyes as you trade more with them. So I'm going to draw this swing high. Pointed this out earlier, how I saw this up move. And now I'm going to swing this. And what am I going to see? Whoops, took off on me. Hold on. That's too steep to do much with. We can talk about what we do in those cases. I don't want to get all into that at this point. But I just want to see, some other moves that might be occurring. I don't want to look at that. Well, I'll look at that. Nah, don't like anything. Maybe I don't see anything. Hold on, give me a second. What can I maybe see? Well, looky. Okay. Once again, you don't need to make, drifted on me. You don't need to make tons of pips, guys. Watch this. So I just swung that. You saw me doing it. Up and down. It's not a traditional fork. Look at the moves that I got. I got a hit here. I've got a hit here. I've got a hit here. Those are all to the pip hits. I got to move down, comes back and checks it. Got a hit here. So, and I get a hit here. Depending on when I draw this, if I just drew it now, okay. But maybe I drew it here and I got to get this bounce trade. Maybe I didn't draw it there. Maybe I drew it here and I included this bounce trade to add to the confirmations that I had to make sure this is in the right angle. And now it's set up perfectly, and look at this trade. One candle. So that one candle, 80, 70, 60, 50, almost 40. By doing the setup, 40 pips, 2% and a 10 pip stop loss, that's an 8% return on your account. In one candle. In one candle. So anyway, I wanted to at least, jump around a few seconds on a live chart. I'm going much longer than I wanted to go tonight. So let me kind of hit the conclusions here. So here's the deal. If you're not already a member, I suggest you join our technical traders group, which is iMarkets Live Scans, Forks, and Fibos and Profits Facebook group. And I'd recommend getting notifications. So when you see pitchforks being painted for you in conjunction with scans, you can copy them to your charts. If you want to follow my Forex exploits on various social media, I am very active on obviously Facebook in this group. I'm active on StockTwits. I'm active on Twitter. I'm just starting with Instagram. Just starting. But StockTwits, Facebook, and Twitter, you'll see routine posts of my forks and scans and whatnot. You can get my social media connections there at stevegregor.com. If you're an existing IML Platinum customer, so you're a member of IML as a customer, I'm going to suggest you look for me in IML TV next week or the week thereafter. Get that schedule, look for me. It'll be something like Scans, Forks, and Fibos as the channel. And as you know, if you can't attend live because time zones are difficult, the last 5 sessions are recorded and posted automatically for you, so you can stay current with me. If you're an existing IML IBO, you know, you're downline from somebody else somewhere in another universe, look, plug into IML TV, guys. It's world-class training from really good educators, and most of them School of Hard Knocks, so it makes them even stronger as instructors. World-class. You know, like I said, it's over 60 hours a week now, soon to be over 70. There's no, oh my gosh, you know, $145 a month platinum, are you kidding me? There were businesses I've had in the past where I've had to make $5,000, $10,000 a month just to put food on my table. I had to cover those expenses. We have an entrepreneurial opportunity to literally have a $5 million, $10 million trading account. For $145 a month? Are you kidding me? And then there's other products you can upgrade to and have a little bit more revenue stream while you learn just the whole IML thing. But guys, if you're an IBO, get your customers on IML TV. Get them there because they will learn how to trade. And if they trade, they're going to stay. So plug your customers in. If not an existing IML member, I'm just going to say you're missing out. I'm not going to do some big hard sales job. This isn't an IML sales call. I'm just telling you. There's no better education. And I can tell you something else as a coach in the Forex because of the number of traders that have come to me. I've been trading for 5 years now. Okay, how's your live trading? Well, I haven't traded live yet. Are you friggin' kidding me? You know why they end up in that situation? Because somebody sold them a bill of goods that they're going to learn to trade of all the free information that's on the internet. Trouble is, for $10 and a few minutes of copy, anybody could put up a website. So the free stuff on the internet, you're hit or miss. And do you really want to spend your time that you could have been with family, working on a hobby, serving your church, whatever, chasing something that's not going to work? Are you crazy? $145 a month for IML is probably the best entrepreneurial investment anybody can make. But don't come in looking to make your riches overnight. I'd say look for a 6 to 9 month run at least, but then you have something powerful. You can travel anywhere in the world, and with a computer and an internet connection, you can trade. The profit per pip, I've tried to demonstrate this. I hope I whetted your appetite. I didn't come here to teach you how to trade pitchforks tonight. There's too much involved. We'll do that over time in IML TV on my channel. But the profit per pip in trading pitchforks is just unparalleled in the Forex. It's worth your time to learn. If you're going to learn how to trade, why not learn how to trade so you're making 10 times the profit? That's the way I see it. If you're going to invest all sorts of time learning all sorts of various stuff, why not learn a real-time technology that you can get in there with high percentage, small stops, big gains? Do I have any quick major types of questions that I can answer for anybody? The recording will be posted for sure in the iMarkets Live Scans, Forks, and Fibos Facebook group. And I'll try and make a post of it in IML Elite for those that are there. Thank you. Again, it wasn't a huge teaching webinar. It was designed to whet your appetite, give you a little understanding of what forks are, why you would want to learn them, why would you want to trade them. It's really the only real-time trading environment in the traditional Forex trading world. And the more you trade them, the more you'll see the magic in the numbers. Well, I'm getting a few things. Yes, the thing with the Schiff is this. So there's a couple different kinds of forks. There's, we talked about the traditional. There's a thing called a Schiff and a modified Schiff. What I'll say is this: 90% of the time, that's a little inflated. 75% of the time, when I do a best fit because the traditional was too steep or something, it ends up that it's a modified. But it's not a bad idea to draw a traditional and a modified at the same time, because you're waiting to get the first bounce off of them. And if I get the first bounce off either one, I'll take it. So I do use modified, just not as much. Most of the time, my best fits are there. I'll see one of my students post a chart, hey, look at this modified Schiff. And I'm like, wait, I have the exact same fork. And I go back and I just did a best fit getting touches, and it ends up, it was the exact same fork as their modified. So a lot of times they are one and the same. So I like forks in and of themselves. If you're an IML member and you're a trader, the scans that you get when you combine them with forks is really powerful. Really powerful. They serve kind of in that synergistic, what's the kumbaya word, symbiotic, way. They feed off each other and they complement each other and they confirm each other. I've gotten a lot of side notes from, Chris Terry. Hey, that was a great fork today. Right on top of a scan, because it confirms the D entry. Yeah, the fork Fibos are really good. Miss Zoe. Oh my Lord. Okay. Well, I'm not seeing. Ray, I do periodic live sessions. I've held back the last month, 2 months, because I knew this IML TV thing was coming. But I do put Pitchforks in here in this group, as do other students, and that population is growing. Got many qualified. I got a lot of students that, I'm very comfortable in them teaching Pitchforks the way I use them, because they've mastered it, over the last 3 to 6 months. So, we're going to continue to teach and expand in here. I want to see the schedule that I've kind of put in a request, and I'm going to see if Jason and Christopher Derrick get it for me. I'm going to have a live schedule, including some traders from this room, that will complement what I'm doing on IML TV, and it'll be done in this group. So it's not going to be in lieu of IML TV. I'm going to do stuff there that if you're not there, it's going to be hard to follow in the group. And I'm not going to give away, what I teach at IML TV to the general public, because that's not fair, and that's not why I'm teaching at IML TV. But I will follow up on what I do in IML TV in this group with posted trades, with posted pitchforks, with video, etc. Cool. And again, I don't care whose team you're on. I'm not out to, there's no cross recruiting kind of thing. I've been coaching forever. Way back when it was FX Trainer, I had other lines, if you will, send their traders to me. And as long as I can help them out, that's all I care. I've been at this long enough that it's kind of some of my way of giving back. So if I can touch somebody's lives, that makes me happy. I don't care if they're, in a line that I'm in or not. So get in this group, follow it, follow me on the channel, bring your customers here, your trader customers, get them in the IML TV. And like I said, guys, plug into that. There's lots of good stuff. I've been, I still 13 years at it, and I've been random sampling here and there throughout the weeks. the various stuff in IML TV, and there's just good stuff there. There's no better source in the world, I'm convinced. Anyway, I don't see any more major questions. I want to thank you for your time carving out, and I always leave you with this. Remember, life can be short. So for those people you care and love, please let them know that you care and love them, okay? Y'all have a good time. Hope to see you in IML TV land.